Welcome to Markets Now. I'm Michelle Rook with Mark Schultz, Northstar Commodity. We're seeing mostly lower prices as we move through the mid-session, with the exception of soybeans, and that's a good place to start. We had a big sell-off yesterday, Mark, and some of that tied to a change in South American weather. So is today just a little dead cat bounce, you think?
Well, yeah, I would say we get a little bit of a bounce. I would like to have seen some export demand pick up with that market dropping 20 to 25 cents a bushel yesterday. We didn't get anything in the daily soybean sales announcement of 100,000 tons or more. Didn't happen. That's probably the most disappointing thing so far. It doesn't mean we didn't have some, we just were no announcements of it. The weather is definitely, for the first time, we've seen weekend weather's rainfall in Brazil turn out to be every bit as good as what was forecasted. And there's still more rain in the forecast as you move forward. So January historically is your wettest month. Now, we're already started some soybean harvest in Brazil. 1, 2, maybe 3% harvested in Mato Grosso. The yields are reported to be rather disappointing. And I would guess whatever is going to be harvested, at least in the next 2 weeks, 3 weeks, probably has already seen its damage done. It might get a little bit better, but it will be below what it was a year ago. After that, that becomes the wild card in here as you move forward. So to me, the moisture has definitely come back in at a time that is going to be beneficial for about 50%, maybe more of the crop in Brazil, in central and northern Brazil. Your southern Brazil has been fine. It has moisture, but it has to start to get just a little bit drier. And the same with a few pockets in Argentina, maybe getting just a little bit drier than they would like to see at the present time for right now. So maybe, but I think enough to the downside that maybe stops the bleeding, but it's the function of, does it rally high enough to where it is feasible? And I don't see that at the present time.
So, Mark, do you think that the lowest Brazilian production estimate is already factored into the market, or do we have more downside to go on that crop? And how much would we have to drop below 150 to get a rally in this market?
Yeah, I've been saying for quite some time that the losses in Brazil have to be a minimum 10 to 15 million metric tons in order to move the market higher than what we had. And that's back when it was at $13 a bushel. I would say we're probably navigating down somewhere, the trade someplace in that 152 to 154 might be, and that's still not enough in my view. But it probably wouldn't take a lot worse or another trend pattern of a shift in the weather to maybe get us back down into that 150 or lower. And if I did that, I think you'd also have to have a combination that USDA report, which comes out next week, shows lower production in the soybean crop in this country. If we got that combination of those two, then I would say we probably got a chance to move the market higher.
But if we don't, do we have a lot more downside risk? The funds are actually now short in this market, aren't they?
They're moving themselves down to even, let's call it basically flat at this juncture. I would guess you're going to have, if you look at the chart, you're going to be on a continuation chart on a weekly. You're going to be somewhere around 1250, 1255 a bushel is going to be your support level in here. And short term, I would say 1330 to 1335 is going to be your resistance level. So you break one of those two, and then you'll probably get another trend direction from there. If you start going below 1250, we got problems. And if you got back above 1335, then maybe you got some better hope for you in the market for the short term.
Yeah. Corn market, let's talk about that. New contract lows again here today. We're down for the 5th straight day. Funds are already short in that market. So how much more downside risk is there?
Well, I was hoping with the short position that the funds were carrying that we would have limited downside momentum here on the corn, and that just has not come to fruition. We have still struggled. We've broken the new contract lows on the daily contracts. Not what you want to see happen there. I think you still have in this country, farmers are still holding a rather sizable amount of corn, hoping for something to move higher. I've still been a strong advocate that the story on the corn is not right up front. The story on the corn would have to be the Safrinha corn crop in Brazil. And that's where you have to have the wet season in Brazil come to an end early. And that you really won't know until you get into the April, May time period. But the bottom line is that corn crop has to come up short of expectations. The wet season has to end early, and that is where you then likely get more of a move on the corn market in the big picture.
Yeah. And the wheat market is set back here as well, but how much of that is the higher dollar versus just the fact that we're still not that competitive or demand hasn't really picked up?
Your demand has not picked up. We had a little bit of a surge there where China stepped in on a 1 week, 2 week period on a buying spree. That's over with, and that's come to a screeching halt. And here we sit on this market. So, you look at the U.S. wheat crop. I was talking to a couple of the customers down here. The winter wheat looks really good as far as the hard red wheat is concerned. They've been having more moisture than they've been typically get in the month of December, so they're sitting well. A lot of good growth on the wheat. It hasn't, in fact, some of it still hasn't even gone dormant, been sitting a little warmer. I doubt that you're going to get any winter kill. You'd have to get some brutally cold. Obviously, we do have a temperature that is going to decline, supposedly in the 10 to 15-day outlook, but you're going to have some significant crop drop in temperature in order to do some problems with the wheat crop. And the demand is just not there at the present time. And the dollar going back up, which last Friday when we closed below the previous 2-month low, I thought maybe we got something to hopefully trend the dollar a little bit lower and maybe to set a direction that it goes down. It has not happened. We're already about 120, 130 points higher on the index just since Friday's close. So not what you wanted to see there in order to pick up more demand. And the wheat desperately needs a demand to pick up, just not in the cards right now.
But you think overall, it's not going to be demand that could solve the problems that we have in any of these grain markets or change the trend. It's got to be a supply shock.
Yep, I have been in that camp, and I'm probably going to continue to be in that camp. And it doesn't matter whether it's the grains or whether it's the livestock markets as well. I think you have to have shortfalls in the crops. And this is what happens when you have a currency that is staying relatively strong and one of the stronger ones in the world. You're just not going to be into the driver's seat of demand-driven market. What we're living and dying off of right now in commodities in this country is weather problems in here, and that's just a bad combination to try to trade because there you have to create these shortfalls of the crop, and we were building on that in Brazil. Now you got away from it and probably maybe needed to go another week to 2 weeks longer. Keep in mind, Brazil stretches out their bean planting over a pretty good time period here, a 2 and 3 month time period before they get the crop all in. And so it's not like it is in the U.S. where it can be done in 2 weeks. The problem stretches out a lot longer. So you have to have crop problem issues longer than you think.
Yeah. Cattle market had a nice update yesterday. So are we just seeing some profit taking because we've maybe run up into some chart resistance, or is this market reacting to this big drop in the box beef values?
I think you're seeing the drop in the box beef values, which is coming back to hurt us just a little bit on that for sustaining a market that's going to move higher. I was still hoping we could get back up at about 174 on the February cattle, at which time I probably think that might be for the short term, a little bit of a run on up. Keep in mind, the cash has been doing quite well here yet. Cash was traded last week, 171 to 173. So we're fine. That pulled the futures on up for yesterday because they were trading at such a sharp discount. When I saw the cutout finishing just over $5 lower yesterday, that really hurt here for the short term. So that puts the packer margins back down in about $70 per head in the red. And we'll see if the cash can firm on up. But even if it does, my guess is it won't have a sustained ability to stay until we start seeing some better cutout prices start to firm back up.
Yeah. And hogs, boy, that market looks pretty tough here. New contract lows again, and the cash market just cannot catch.
No, it can't catch a falling knife in the cash right now. And the discrepancy between the cash market, what's being paid for guys with cash contracts versus the guy who is in the pork cutout contract, it's absolutely astonishing of the difference that's being paid in here. We've done well with our pork export business here in the last 3 to 4 weeks. Pork is still relatively cheap of all the meats that are there. So one would like to think you'd get some more business, but we simply have too many pigs coming to market. Packers can't handle all the pigs that they have. The weights are starting to creep higher. Customers of mine, just if they want to have 15 or 20 loads a week, are being cut back by 4 or 5 loads a week less, and that just pushes it back a little bit further in here. And I think a lot of it still has to do, we just don't have enough kill capacity, and we don't have enough workers in the kill capacity industry for the meat market.
Yeah, and it doesn't look like any of that is going to change anytime soon. All right.
It doesn't look like it's going to change. Low prices eventually get going, but here too, I mean, in the hog sector, you've got a reduction in the number of sows. We're going to cut back on sows, but then pigs per litter come right back on up, and they go to record highs. So we don't gain any ground. It's kind of like the dairy business, the same thing. You cut back on some milk cows, but milk production increases. So just like in the grains, you have to have shortfalls in production. And right now, you look at the winter weather here, and it's been ideal. I mean, I get guys with hogs moving to market week to 10, 15 days sooner than they normally are supposed to. And the same is true with the cattle, 2-3 weeks ahead of schedule for what they're on the weight gain. So it's been a wide open winter. Now, maybe the cold weather gives us a little bit of a shock in here, but that'll be more for cattle. But it won't be much for the hog market, though.
Yeah, and the weights certainly do reflect that. All right, thanks for joining us. Mark Schultz with Northstar Commodity. That is Markets Now.